Hello bankers, a very good evening to all of you. Welcome back. So guys, in this particular session we are going to discuss our unit number 24. Very important one from this particular module. So that is all about capital structure and cost of capital, right? So in this particular session, like we have done with these many units. Okay. So now the next one is capital structure and cost of capital. So which include like you can expect 3 to 4 marks question based on this particular unit, and mostly it is case studies, right? So we have the basic introduction and then factor influencing decision on capital structure, theories of capital structuring, okay, taxation, concept of cost of capital, cost of debt and cost of equity, then weighted average cost of capital, factor affecting weighted average cost of capital, marginal cost of capital, then we have flotation cost and cost of capital. So these are some subtopics which are very important from this particular unit, right? So most of the time examiner they ask one question around the factors, the another one question for sure you will get from this particular one, okay? So especially that net income theory of David Durant, okay? Then taxation and capital structure, this will be kind of a case study combination of these two. Then one question for sure you'll get on weighted average cost of capital every time they ask this question here, and flotation cost and the other one also. Okay, so these are some important subtopics which are generally part of this particular unit. So we will be discussing all these one by one. Okay, before that I have started taking live session for your November 2025 examination as well. Okay. So for AFM, those who are only part of specific AFM batch, so your classes will be on Thursday, team. So Thursday and Friday and आपका Saturday. ठीक है? These 3 days I'll be seeing you with live classes at 7 p.m. ठीक है? So you'll get notification if you are specifically part of any AFM course and all. ठीक है? So please make your availability on this particular one. And the prerequisite is you have to watch the concept videos. Okay? Though with the help of questions and concept, we will be trying to revise or build our concept also, right? So let's start the discussion. So when it comes to capital structure, this is again like this is a topic which will help you in ABFM subject in your CAIIB examination also. And if you go for any other examination, 100% this will be a part of that one also, right? So guys, when it comes to capital structure, it is like how companies they are arranging their overall funds, take a sources of funds, take a, like let's say companies or businesses they do some sort of they are planning for some sort of business expansion and all, okay? So for that expansion they'll be requiring some sort of funds, okay? Let's say there is an XYZ company who is planning for any sort of expansion, okay? And for this their capital budgeting is suppose that they require a budget of suppose that 100 crore rupees, okay? So they need 100 crore rupees to finance these particular activities and all, okay? Now like by what sources they are going to finance these particular activities, okay? So they can have two major areas. One is the equity, which is आपका sale of ownership. Another one is आपका debt, ठीक है? Debt is kind of this is outside liability, ठीक है? So these are the two one, ठीक है? When it comes to choices between equity and debt, that is your capital structure decision making, ठीक है? And this is the capital structure. Let's say there is a company like let's say this XYZ company, they are planning for a ratio of 30:70, ठीक है? That means 30 crore rupees they are going to raise through equities, and 70 crore they are going to raise through your आपका debt portion in loan, bonds and others, ठीक है? So overall 100 crore rupees आपका. Now these decisions, like before making this kind of decision, which is part of the optimal capital structure, it can be differ from each and every business or industry wise or based on the financial risk, okay? How we decide this particular one, we will discuss that particular one, okay? But most of the time what you will see ki, yeah, the two elements, one is equity. When it comes to equity, basically this is something where you are going to share some sort of ownership, being a owner of this particular company in this in term of shares. ठीक है? You do not have to pay any sort of interest on these kind of this kind of for this, like let's say you issue 30 crore rupees equity in the market, you do not have to pay any interest on that particular one. When it comes to this is outside liability, and this you have to pay back, you have to pay them the lenders basically amount which is after in term of interest itself, right? And you have to repay this particular amount after the committed time, right? Now companies, when you'll see maximum time, you'll see the debt portion is higher than the your equity portion, because there are so many reasons behind this one. Okay? For the core reason are like, with debt we got some sort of financial leverages. Okay? So while you raise funds through debt, it will help you to increase the market value of that particular company. Let's assume the company's market value is 1000 crore. Okay? Now they issue, if they issue 100% equity, 100% equity, if they raise, means this 100 crore rupees through equity only, their market value will remain 1000 crore only, because from this ownership itself they are sharing some ownership point with the common shareholders team. But when they raise this particular one, let's say if they are raising this particular one 100% through debt, so now their market value will increase to 1000 crore plus आपका 100 crore. So their market value will become 1100 crores आपका, ठीक है? 1100 crores in this case. So this is called trading on equity or the financial leverages, ठीक है? Now, but here in this particular case, you have to pay, this is your outside liability, so you have to pay return the interest to the users also. Now, you'll never see something like this, but most of the time there will be the combination of both equity as well as debt. But maximum time the debt portion will be higher, because one thing, it help company to take the financial leverages, it increase the market value of company, and the interest you are going to pay to the customers, that you can show as a operating expense, so you can adjust that particular one before tax payments. How it will make an impact, very important. Let's say there is a company who raise this one, okay? So suppose that they raise like if they go with this particular one, suppose that tax rate is in India is 25%. Okay? So in this particular case, they are not paying any interest. So the total tax will be zero. Okay? They won't get any benefit from this one. Okay? But when it comes to this one, okay, so let's say during that particular period, now like they have, sorry, tax rate will be 25%. So 100 crore ka, like whatever profit they have made, okay, let's say their profit during that particular period is आपका 10 crores. So 10 crore का 25%, that is 2.5 crore rupees they have to pay as a taxes आपका, ठीक है? Whatever the number it is, ठीक है? 2.5 crores or 25 lakhs, ठीक है? So that they have to pay as a it is 25 lakhs only, ठीक है? Not let's assume it is 100 crore. Okay, they made a profit of 100 crore rupees. Okay. So they have to pay taxes of 2.5 crore rupees in this particular case. Now, when it comes to the debt side financing, what will happen? Okay, let's say their profit is आपका 100 crore rupees, okay, and the interest paid by the company, let's say the interest paid on this debt form was, suppose that interest was equal to 10%. So that means 10 crore rupees. आपका 100 crore का 10% is 10 crore rupees. So this आपका 90 this will become 90 crore. ठीक है? So you have to minus the this, and 90 crore का at the rate of 25% they have to pay the taxes. ठीक है? See, so with this debt portion they are getting a benefit of they are getting tax benefit also, because here this 10 crore rupees which we have paid to the these lenders, that will get deducted as an operating expense. So this is something which we have. Yeah. So every tool they have their own benefits or their own liabilities. Yeah. And why companies they keep this particular one high? There are two major reasons. One is the overall market value will increase. Another one is they'll have tax benefit also. And in this case, the owner, they generally lose the degree of control also. Now there is one another thing which is called cost of capital. So when it comes to cost of capital, it is as simple as that. Again, so cost of capital is equal to और कॉस्ट ऑफ डेट इज इक्वल टू आपका, ठीक है, विच इज जनरली नोन एज केडी, ठीक है. सो कॉस्ट ऑफ डेट इज इक्वल टू योर कॉस्ट ऑफ इक्विटी प्लस आपका कॉस्ट ऑफ डेट, ठीक है. सो कॉस्ट ऑफ डेट, so these two आपका which is generally part of this one. When it comes to weighted average cost of capital, so it is how we calculate weighted average cost of capital. It is equal to cost of equity into portion of equity, again portion of equity plus आपका cost of debt into portion of debt, ठीक है. So that is the formula to calculate this one. So you'll get weighted average cost of capital of that particular company, and based on that particular one only you'll get the questions also. So when it comes to capital structure, it is all about how companies they are managing their budget, from which sources they should raise funds, okay, that get that bifurcation between equity and debt, that is called capital structure, okay? And how what should be the optimal ratio for this one? There are so many elements, and for that sake we have three major theories. आपका net income theory, ठीक है, the another one is net interest income, आपका irrelevant theory and traditional theory, right? So these are the areas, ठीक है. And why debt portion is higher? What is weighted average cost of capital, cost of debt, ठीक है, weighted average marginal cost of capital, and others. These things they are interlinked with each other, and even the tax benefit also. So we will be discussing all these particular one by one in this particular session, okay? So when it comes to आपका basically this is generally known as balance sheet equation. Asset equal to आपका liabilities plus owners equity, ठीक है. So what should be the portion of equity and debt? What will be the portion of equity and debt? That is generally known as your capital structure, ठीक है. Let's say it can be आपका 50-50, ठीक है, or else it can be your 20-80, or it can be your 70-30, or the others one, ठीक है. So it is depend on the type of business and their the financial risk or the overall business risk involved in the market itself, ठीक है. So there are two major elements. One is equity, another one is debt. Now we can have equity, we can have different type of equity, like preferred equity, or the common equity. In case of debt, we can have different sort of different form of debt, like we can have bank loan, term loan, it can be in the form of debentures, it can be in the form of bonds and others, okay? So that's generally part of this particular one, okay? So in this particular session we will be discussing all these things. So capital structure refer to a specific mix of debt and equity used to finance a company's assets and its operation. From a corporate perspective, equity represent a more expensive, you have to always remember this particular one, okay? So cost of equity is higher than cost of debt. That's why most of the time what you will see, so as I mentioned there also, so let's say the debt to equity ratio is supposed that why it is 70:30, because the cost of equity is always higher than cost of debt, okay? So because we lose the degree of control, though you are not paying any interest on this particular one, but you are losing आपका degree of control, you are not having that tax benefits and others, so that's why this become expensive, okay? But it is a permanent source of capital with greater financial flexibility, right? So debt and equity are the two primary type of capital sources for a business. Capital structure is defined as a combination of equity and debt that is put into use by the company in order to finance the overall operation of the company and for its growth. Okay? As I gave you an example of that XYZ Limited, okay? They are planning for the expansion purpose, and for that expansion purpose they need, let's say, 100 crore rupees. Okay? So how they are going to arrange that particular one? So they are arranging through the source of they can have either equity, either debt, or a combination of both. Mostly companies will go with the combination. Now when it comes to optimal capital structure, so there is no fixed ratio for industry wise or for companies. It depends on company as well as the industry type आपका, ठीक है. So majorly टू सोर्सेज आपका, वन इज बिजनेस रिस्क, ठीक है, अनदर वन इज आपका फाइनेंशियल रिस्क. सो व्हाट टाइप ऑफ बिजनेस रिस्क एंड फाइनेंशियल रिस्क इन्वॉल्व इन दैट पर्टिकुलर बिजनेस, that will decide your optimal capital structure ratio. ठीक है, it can be like 50-50 or your 60-40, 40-60, 65-35 or anything else also. ठीक है, it totally depend on these particular sources. ठीक है, and even like the internal policies of the organization or the government norms or the other sources also. ठीक है, so optimal capital structure is referred to as the perfect mix of debt and equity financing that help in maximizing the value of company. That this can be done through debt portion in the market while at the same time minimize the cost of capital. That means you have to also consider the equities at a lower side. Okay? So that is a kind of things, and eventually it will come to the आपका financial risk and business risk आपका. ठीक है, now next one, financial leverage. So as I earlier told you about this, ठीक है, so whenever it comes to financial leverage, leverage is basically like we used to say one statement now, derivative are highly leveraged funds. ठीक है, so with less investment you are getting more value. Similarly here also, when it comes to financial leverage, it is equal to the portion or the amount you are raising through debt. ठीक है, so financial leverage in case of capital structure is the portion of debt you are having in your capital structure, right? So when, as I gave you an example, ki the company's XYZ, let's say there is a company, okay, to purchase asset, they raise some funds आपका, and they what is the basic idea behind this? Okay, let's say there is a company whose current market value is 1000 crores, okay, they raise 100 crore rupees debt आपका, ठीक है, now their market value will become आपका 1100 crores, ठीक है, why? Because they have borrowed it at 10%, suppose that, again, and the return on investment, again, let's say the ROI on these particular investment is suppose that 15%, so they are paying back that 10% also, still they are having 5%. So this way we utilize this, and this is also known as trading on equity. Okay? So financial leverage is when companies take a debt for investing in business operation to gain profit in return. So that is called financial leverage, and this is done through the debt portion also, right? So financial leverage is defined as proportion of debt that is part of the total capital of the firm. It is also known as capital gearing. A firm having high level of debt is called highly leveraged, and low level of debt आपका low leverage, right? So, but it is suggested by number of theories कि when it comes to equity and debt, the debt portion should be higher side because we have tax benefit, we have it help to increase the market value, or like while your investment are perfectly assigned or aligned, so your ROI will be obviously higher than your overall purchase debt आपका, ठीक है, so this will give you benefit in so many ways as well, right? So that is the thing. So basically what we are doing, we have borrowed 100 crore rupees at the rate of 10%. This is people's money. We invested this particular one and in our business, and let's say our ROI is आपका 15%. So 10% we have to return back to the investors. Remaining 5%, it's still you are in like kind of a, you are making money from others' money. Okay? So you are making you are increasing the value of your company by using others' money. So that is something which is generally part of this particular one. Okay? Now, factor affecting capital investment, or sorry, capital structure decision. Very, very important one. Okay? So this get asked for 1 marks or half marks so many times. So please go through these particular one. If you have understood the concept of capital structure, you will be able to easily relate all these particular one. But this is something which is which is kind of exam questions which get asked so many times. So you have to remember these one. Okay? So first one is आपका norms in financial system. That means the guidelines of that particular country or the industry. Okay? So like in case of India, so we have some specific guidelines. We have regulators and all. Okay? So you have to fulfill those particular one first. Okay? So lending policies of bank or financial institution restrict debt equity ratio. Excessive debt is not allowed beyond reasonable levels. Rating agencies also assess debt equity proportions. The another one is degree of control. So if you'll go with degree of control, that this is something which is linked with your आपका equity. ठीक है? If you issue more equity, you will lose as a owner. You will lose ownership in that particular business. ठीक है? So promoters avoid diluting आपका voting rights by issuing more equity. Prefer debt instruments like debenture to raise the fund also. ठीक है? Trading on equity, that financial leverage that we have discussed. ठीक है? Using debt can increase return on equity if earning exceed borrowing cost. As I gave an example of 10%, we borrowed on an average 10%, and our ROI was आपका 15%. ठीक है? So this will help to increase your overall valuation by 5% also, and similarly the other areas also. ठीक है? More debt आपका higher profit per unit of equity if business perform well in this particular case आपका. ठीक है? So that is one. Apart from this, cost of debt is also important here. So as we all know, cost of equity is higher than cost of debt. ठीक है? So that's why we favor the आपका debt portion in our capital structure. ठीक है? So interest is tax deductible, but high debt increase the financial risk. अब it should not be 100%. ठीक है? That's why I told you कि like we cannot have 100% equity, 100% debt. Okay? We have to manage things. We have to find out an optimal structure for our business based on the business risk and the financial risk. Okay? So it can be like in that particular one, theories they generally support that debt portion should be higher. So that means we can have debt to equity 60 to 40 or 70 to 30. But till you can increase that debt portion till some extent. Beyond that, it will like there will be some sort of आपका high debt increase of financial risk, so that will increase your financial risk also. Okay? Beneficial only under favorable business conditions where you will be able to achieve this. Your borrowing is आपका 10% and you are gaining 15%. If it is आपका 7%, then that debt will become financial risk for your business because you have to pay from your pocket now, right? Average condition may lead to insolvency if firm cannot cover the interest cost. Okay? This is the one. Okay? Or if there is any, let's say we have taken debt, we deploy in some project and it gone like that project got a failure. Okay? So in that case, you have to pay from your pocket for the coming years, right? Size of firm and business plan also. So large firm may sustain higher equity while smaller firms prefer debt for easier payments. A firm with a limited expansion plan may keep a low equity capital. Reducing equity is difficult due to regulatory restrictions also. Okay? Let's say once you have released the shares, maybe the shareholders they do not sell back those particular one if you are planning for any sort of buyback. But in this case of debt, you have fixed time duration, fixed interest and everything. So during that particular one, you have to pay that particular. Okay? So this is something, these are some core factors which generally affect the capital structure decision. Now the next one, which is like whenever companies they decide their capital structure. So for that sake, we have three major theories. So theories of capital structure. One, net income theory, another one is net operating theory, and the third one is आपका traditional theory. ठीक है? So now out of these three theories, the most famous one is आपका net income theory of David Durant. This is also given by David Durant. This is some lady, I just forget this name, it will come. ठीक है? So when it comes to the basic introduction of all these particular theories, what David Durant suggested in this particular theory, he said कि in a like while companies they are planning their capital structure, means आपका the portion of equity and debt. ठीक है? So the debt portion should be higher. ठीक है? So the debt portion should be higher. ठीक है? And all those arguments like taxation or that it helped to increase the company valuation and all, those all were given by David Durant in his theory called आपका net income theory. So what he says is कि companies in their capital structure, they should have max to max portion of debt. And like if you'll have that particular thing, so you'll get benefit of taxation and it will help a company to increase their valuation also. The another one is net operating income theory, which is also known as irrelevant theory, and which is again given by David Durant. Okay. In this particular theory, what he suggested? He suggested the decision of equity versus debt is irrelevant. There is no impact of how you keep these particular things, that does not affect your company's valuation and all. Okay. The third one is traditional theory, which is aligned with your आपका net income theory. Traditional theory which generally support to net income theory, and they generally suggest कि like the portion of debt should be at higher side आपका compared to equity, but till some extent. ठीक है, there should be some limitations on debt also. ठीक है, because if you go beyond these limitations, it will start having negative impact on your business. ठीक है, so you will start facing the business risk and all. So three theories. The core idea, आपका the debt portion should be maximum to avail the tax benefit, or it will help to improve your to increase your company valuation. Second theory, the debt and equity proportion that does not affect the business. These relations are irrelevant. Third theory, which generally support net income theory, debt portion should be higher, but till some extent. Okay? You cannot breach those particular line. If you go beyond those particular one, there will be a inverse impact of this debt. Okay? The benefit you are getting from those particular one. Okay? So one by one. So out of these three, maximum time, 90% time you will get question based on this particular one. This is one of the most famous theory of your capital structure. Okay? So net income theory, this theory is given by David Durant, who put forward the idea of increasing the proportion of debt in the overall capital structure. According to him, debt is a fund source because it has a lower interest rate, eliminating the risk factor and playing a significant role in deducting expenses as income tax. How come? As I gave you an example now, कि there is a company आपका who made profit of let's say 100 crore rupees. ठीक है, they made a profit of 100 crore rupees. ठीक है, and tax rate in India are basically how much? 25%. ठीक है, let's say 25%. So now while let's say you have 100% debt, ठीक है, so suppose that your capital is let's say your capital is आपका suppose that it is 100 crores only. Okay? So suppose that your capital is also 100 crore. That means you have raised 100 crore rupees money from the debt sources. Okay? So let's say we have this entire amount we have raised through debt. So how this debt will help you? How this theory will help you? Okay? So your profit is आपका 100 crore rupees. 100 crore rupees minus the interest you have paid on this. Okay? So you do not have directly pay taxes on this 100 crore rupees. Okay? Let's say your debt was 100 crore rupees at the rate of 10%. That means 10 crore rupees, right? So you have to minus this 10 crore rupees. So now you have to pay taxes on 90 crore. So 90 crore ka 25% you have to pay the taxes. But in case of equity, let's assume it is 100% equity. In that case, what will happen? You have to pay 25% taxes on this particular, because you are not paying any interest in case of equity. They are owners. So if you will have, now we are not suggesting the entire 100% debt portion. What we are suggesting, कि your debt, let's say it is 70% and your equity is आपका 30%. ठीक है, we are keeping debt at maximum side. ठीक है, so out of let's say now this capital which we have borrowed from the market or the source of funds, it is let's say we have debt portion आपका 70 crores and equity portion is आपका 30 crores. ठीक है, so now you have to calculate this. So let's say on this 70 इस पे we have paid 10% of taxes. ठीक है, so it will आपका 7 crore rupees. ठीक है, so 7 crore rupees taxes we have paid. ठीक है, so whatever profit you have made, so this let's say profit is 100 crore rupees during that period. Okay, so you have to minus 7 crore, then you have to pay. If it will be, let's say if it will be 80 crores, so what will be the situation? Okay, this will be 80 crores, you have to minus 8 crore. So 1 crore other relaxation, it will be 50-50, so it will come to आपका 5 crores. So that is the relation. If it will be at lower side, you have to pay more and more taxes on your profit. If it is at higher side, you have to pay less taxes. Okay? And the another one is the trading on equity. If you are utilizing that particular money very well, if your return on investment is higher than the average borrowing, also it will help to increase the value of equity or the firm value, right? So net income theory, according to this approach, capital structure decisions are relevant. The value of a firm, to the value of firm, how come? Let's say we raise 100 crore rupees through debt, okay, on an average 10%, and our ROI, return on investment, was suppose that आपका 20%, ठीक है. The project where we invested that 100 crore rupees, that generated us 20% ROI, ठीक है. So that means after paying this 10%, still you will have 10% in your hand. So this is your profit. So it will increase the company's valuation also. Okay? So it will help to increase the company valuation. So this is the one. Okay? An increase in financial leverage, debt proportion, will lead to decline in weighted average cost of capital also. Okay? 100% true. Okay? While the value of firm as well as the market price of ordinary share will also increase. How these three will increase? The second portion, this we have discussed. So how the company share will increase? Suppose that earlier the company's current market price was 100 rupees, per share price was 100 rupees. Now they made a profit of 5%, so this will also increase. If company is making profit, so obviously if their balance sheet at a positive side or profit and loss at positive side, so this share price will also increase. The another one is weighted average cost of capital. Like, let's say how we calculate weighted average cost of capital. I told you earlier also. So weighted average cost of capital is equal to cost of equity, into portion of equity. ठीक है, portion of equity. ठीक है. So plus cost of debt into portion of debt. ठीक है, portion of debt. Now how it will affect? Let's say there is a company who borrow, whose capital means their source, they borrow 100 crore rupees. ठीक है. Case 1 आपका, they borrow this entire money through debt, 100% through debt. ठीक है. केस 2 आपका, बी इज आपका कंपनी बी, 100% थ्रू इक्विटी. ठीक है, इक्विटी. एंड केस 3 आपका, ठीक है, लेट्स से आपका डेट टू इक्विटी रेशियो. ठीक है, डेट टू इक्विटी रेशियो इज आपका 0.50. ठीक है, 0.50. ठीक है. So means 50% from debt, 50% from equity. Now let's say this they raise this 100% through debt at the rate of आपका सपोज दैट 10%. ठीक है. द कॉस्ट ऑफ इक्विटी इज सपोज दैट एट द रेट ऑफ 15%. ठीक है, एंड 10% 15%. ठीक है. नाउ सी for first one, for case 1, what will be your cost of debt? ठीक है. So weighted average cost of capital, it is very simple. ठीक है. In case 1, for case 1, they are weighted for A, weighted average cost of capital is equal to 10%. ठीक है. For B, weighted average cost of capital is equal to 15%. ठीक है. For case C, आपका the weighted average cost of capital, how you will calculate cost of debt? Cost of debt is आपका how much? It is 10%, ठीक है, into आपका 0.5. So it become आपका 5. ठीक है. And cost of equity आपका, sorry, cost of, this is 15. ठीक है, cost of equity is 15%, 0.5, so it will become 7.5. ठीक है. Cost of debt is आपका 10% into debt proportion of debt, it is 0.5, so equally, so 0.5, so it become आपका 5. ठीक है. So 7 plus 5, 12. So for case C, आपका weighted average cost of capital is 12.50%. ठीक है. Now this is the situation. So now we'll enter one situation here. So if this company C, okay, because the first two are straightforward. Okay? In company C, if they change their, if company, now there is one another situation given, if they apply net income theory and if they are planning to change their debt to equity ratio, आपका debt, they are planning to increase debt to 70% and equity equity at 30%. Okay? So they are increasing the portion of debt, so it will decrease the portion of equity. So how it will impact companies' weighted average cost of capital? So now weighted average cost of capital will come down. Okay? It will come down. It will come down too. So now cost of equity is आपका 15 into the proportion is 0.3. ठीक है. And when it comes to cost of debt, it is आपका 10 into 10 into 7. ठीक है, 0.7. ठीक है. So this is the one. So obviously your outcome will be less than that. And the outcome, the new weighted average cost of capital will be 15 into 0.3. So it is 4.5. ठीक है. So it is आपका 4.5. Earlier it was 7.5. And the cost of debt will be, आपका cost of debt will be, it is 10 into 0.7. ठीक है. So it is 7. ठीक है. So it is 7. So it is 7. It is 7 and it is 4.7. So the outcome is 7, 11.50. Okay? So if they increase the portion of debt, if they are increasing the portion of debt, so their weighted average cost of capital is comes down. Okay? So that is the logic which is generally part of this entire theory. I hope you get this particular point clearly. We will be practicing number of question around this. You'll get exact this type of question. Okay? They'll give you either this is the cost of capital, cost of debt, and others. Okay? What is the weighted average cost of capital? First question. Another question will be something like this. Okay? The element 2 आपका. Now company is planning to increase their debt portion to from this to this. So how it will impact companies' weighted average cost of capital? So if they are increasing their portion of debt, that is debt cost of debt is lower, so the weighted average cost of capital will come down. And if they are increasing the portion of equity, cost of equity is higher, so their weighted average cost of capital will also increase. That is the logic behind this one. Understood? So this is something about the net income theory. I hope you get this thing. So like here also in your book, if you open your book, so you'll see this case. So ABC Limited has capital structure comprising 50% debt, 50% equity. Okay? So they have raised capital 50% debt, 50% equity. The cost of debt is, in this case, cost of debt is आपका 10%. Okay? And cost of equity is 16%. Weighted average cost of capital, how you will calculate weighted average cost of capital? So it is cost of debt into portion of debt plus आपका cost of equity plus proportion of आपका equity. So 10 into 0.5 and 16 into 0.5. So we reach to 13%. Understood? Now, if the capital structure is changed to 60%, okay? So now they are increasing the portion of debt. They are increasing the portion of debt to 60%. Earlier it was 50%. Okay? And so the equity will come down to 40%. The weighted average cost of capital will change. How? So it will आपका, the new weighted average cost will become 12.40%. They have increased the portion of debt. Obviously your weighted average cost of capital will come down. So 12.40%. So this is the relation आपका. ठीक है? So this is clear that the proportion of debt increase, weighted average cost of capital will decrease, and the value of firm enhance. On the other hand, if there is a decrease in the debt or leverage, weighted average cost of capital will decrease. Increase, sorry. So that is the logic behind this. I hope you understood this particular one clearly, because this is thing which they are definitely going to ask. Even this is like they have a dedicated subtopic for weighted average cost of capital also. Now the another one, the next theory, again which is given by David Durant. It is also known as irrelevant theory of आपका net income theory. ठीक है? So capital structure. They generally believe कि there is no point of deciding this ratio of equity and debt. ठीक है? So net operating income theory, as it is known as irrelevant theory, it was also given by the proposed by the David Durant. A deficit, the company's market value is not affected by changing the capital structure. They assume कि there will be no impact if you change the capital structure of your business. The overall cost of equity can remain fixed no matter the proportion of debt also. So according to this approach, capital structure decision of a firm are irrelevant. Any changes in leverage will not lead to any change in total value of the firm, and the market price of shares as well as the cost of capital is independent of the degree of leverage. Okay? So they are clearly saying that there is no relation between these two. It is like it remain fixed with the time duration. Now next one, traditional theory. So when it comes to traditional one, they are aligned with आपका net income theory, but they have like what they said कि the portion of debt should be higher, but there should be some limitation on that. If you'll go beyond this, it will start giving you negative impact, right? So the traditional theory which is given by Ezra Solomon. Ezra Solomon was the person behind this who generally agreed with David Duran net income theory. The assumption of this approach are quite related to the net income theory. The main principle behind this theory was to increase the proportion of debt to a certain limit in a capital structure. There should be some limits. You cannot go beyond those particular limit. If you go there, that will start having negative impact. This approach favor the result of financial leverage up to some point. Cost of capital come down and the value of firm increase. However, beyond the point, a reverse trend emerges. Okay? So if you go beyond those particular lines, you will be having some sort of losses, or that will start financial risk will start impacting your overall business. Okay? So now the next point, these three theories, maximum 90% time net income theory will be part of your examination because that get used in real world. Okay? Now the next one, we have taxation and capital structure. So as I earlier told you, the benefit of taxation. If you go with equity, you have to pay taxes on net income. Let's say net income, let's say your income during that particular period is suppose that 100 crore rupees. If your capital structure is 100% financed through equity, so you have to pay taxes on this particular profit. Okay? But if you have a portion of debt, okay, this is something which is linked with the theories. Okay? So if you have, this is through आपका equity. Okay? The another one is if you have debt portion आपका, let's say if it is financed 100% through debt, so the profit minus आपका interest paid, whatever interest we have paid, that you have to minus, then you have to pay the taxes. That is the one. So that's why if you're having higher debt portion, let's say during this period our profit is suppose that 50 crores, profit is 50 crore. So now on debt, let's say we have paid interest of let's say 10 crore. So interest was 10 crore, so you have to minus this one. But in case of equity, you do not have any sort of after interest payments and all, so that will not be part of this particular one. So these taxes also helping you to maximize the profit or the company's valuations. So let's discuss this particular one. Taxation. Interest on debt funds is allowed. Deductions is as it is a business expenditure. Therefore, it may increase the rate of return on owner's equity. The cost of raising debt funds is treated as revenue expenditure. So basically, expenditure for that particular period, operating expenditure. Revenue is like short term within a year. It can be claimed as deduction in computing the total income. So what we do, profit minus आपका interest, then we pay the taxes. So here I took from your book itself. When determining the firm capital structure, taxation must be taken into consideration. As we have discussed earlier, earning before interest and taxes of a firm will not be affected by the capital structure of the firm. If a firm has a bit of 100 lakhs with 100% debt and 0% equity, it will have the a bit of 1 lakh. The capital structure is 0 debt and 100% equity. So what will be the in this particular profit in this? Okay, there should be in this is the situation actually that was just point. Okay? So this is the case which you have to understand. ABC having total capital 2 lakh means they have raised funds after 2 lakh rupees. And EBIT is 1 lakh rupees. They are आपका earning before interest and taxes is 2 lakh rupees. Sorry, 1 lakh rupees. During this period of financial year, they have raised, they have made a profit of 2 lakh rupees. Income tax on the firm is 25%. Again, rate of interest on debt is आपका 12%. So now we have three scenarios. First one, we have discussed the similar type of question. I hope you remember. Again, scenario one, 100% debt and equity capital is zero. Again, another one is 50% debt, 50% equity, and third one is आपका debt is zero, 100% equity. So in case one, if you come to this particular one, scenario one, where we have 100% debt, means this 2 lakh rupees we have raised through आपका borrowings or in the form of loan and all. So 2 lakh का 12%, which is आपका 24,000. So you will minus from this 1 lakh. 1 lakh minus 24,000, 76,000, and you have to pay 25% taxes on 75%. But in case of scenario C, you have to pay taxes at the rate of 25% on 2 lakh rupees directly. So you will pay more taxes in that case. Third case, आपका medium. So here you can see capital is 1 lakh rupees. EBIT, sorry, the profit earning before interest and taxes. Debt was 2 lakh rupees. Interest is आपका 24,000. So it is 12% of your आपका 2 lakh rupees. Now, so before tax income is आपका profit before tax, it is 76,000 minus, now you have to apply the taxes to 25%, so it is 19 this. So this is the profit. Okay? After tax, profit after tax. When it comes to आपका scenario B, first consider the scenario C. Here 1 lakh rupees is their EBIT and 2 lakh rupees is capital. 1 lakh, here you have to pay more taxes. In this case, you have to pay 19,000 taxes. Here you have to pay 25,000 because this we will adjust in case one as a operating expense. Okay? So this is the number. Third one आपका 100 like EBIT is 1 lakh. Okay? And the equity and debt ratio is 50-50. That means out of this 2 lakh rupees, 1 lakh rupees we have raised through equity, 1 lakh rupees through debt. So now on debt, we will not, on equity, we will not have that benefit of taxation, but on debt, we will be having that benefit of taxation. Okay? So 1 lakh rupees आपका is your debt. Okay? So 1 lakh rupees is equity. So 12% only. So आपका 1 lakh का 12% is 12,000. Okay? So after 88,000, 22,000 is the taxes. This is the one. So this is something how taxation, they help businesses to increase the market value of their shares or to adjust that particular profit. So you are raising funds from others, you are increasing your market value, you're deploying that particular funds in the market, you are making profit, and whatever profit you are getting or whatever interest you have paid, you are minusing that particular one. So eventually it is benefiting the business itself. So this is the benefit of taxation, that is called financial leverage, and that's why every time you will see that portion of debt is always higher than portion of equity, right? Now this portion we will be starting in next unit, otherwise you will get confused. Okay? So I'll see you at 7 p.m. So in next session, first we will be discussing आपका cost of capital, weighted average cost of capital, factor affecting weighted average cost of capital, very important. Okay? Weighted average cost of capital, flotation. Then after that, we will be discussing a set of questions also, so we can have more clarity around this particular topic. I hope you get these particular thing clearly. Very interesting topic, and topic this will the same things or the fundamentals will also help you in your CAIIB examination. All right, guys. So this is it from my side, and please do remember those who are preparing only for AFM. So Thursday, Friday, Saturday, 3 days we'll be having live class at 7 p.m. on your application itself. Okay? So please do join that particular one. You will get notification just before the starting class itself. Okay? So do join those particular one. Okay? And you can ask your number of queries and all. We will do unit-wise revision in those particular session as well, right? So this is it from my side. Thank you for joining this session. Thank you for watching this session. I'll see you tomorrow at the same time. Bye-bye. Take care all. Have a nice day. Thank you.